Most people do not lose money because markets fall. They lose money because the moment prices finally become attractive, their mind becomes expensive. I have watched this pattern long enough to know that what ruins ordinary investors is rarely the first drop. It is the behavior that follows the drop. It is the panic sale, the frozen hand, the sudden need for certainty, the urge to wait for one more headline, one more meeting, one more clean signal, one more official blessing that the danger is over. By then, the auction room has already done its work, and the best prices are gone. That is the real punishment in markets. A bear market is not just a decline, it is an auction room. It is one of the very few moments in economic life when strong assets, broad ownership, and future cash flows are offered by frightened people to patient people at marked down prices. Most people walk into that room and feel fear. I walk into that room and ask a simpler question. What exactly is being sold, and who is selling it to me? You need to understand the difference between a falling price and a broken asset. Those are not the same thing. In 2022, the whole market dropped hard. People spoke as if capitalism itself had slipped a gear. Energy spiked. Food spiked. Inflation hit hard. Rates moved fast. Supply chains got twisted. Technology stocks that had been treated like royalty suddenly got treated like a bubble. The broad market finished down hard, and many people told themselves a dramatic story. They said the old game was over. They said this time was different. They said prudence meant stepping aside. Then the market did what it has done to impatient people for generations. It turned, it recovered, it kept climbing, and the people who sold low did not feel disciplined. They felt sick. They spent the next 3 years telling themselves that the rebound was temporary, that the next leg down was inevitable, that getting back in after a big recovery would be foolish. They waited for the perfect re-entry. Perfection never arrived. Price did. That is how wealth transfers in public markets, not through secret formulas, through behavior. Now I look at the present and I see why so many people are uneasy. I see the familiar ingredients, geopolitical conflict, again, supply chains again, oil pressure again, technology concentration again. This time the fear is not called a tech bubble in the old language. It is called an AI bubble, same anxiety, new costume. I see a central bank refusing to give investors the easy relief they had already started to expect. I see inflation still powerful enough to hold the knife over rate cuts. I see the market reacting not only to what is happening, but to the disappointment that what people wanted to happen is not happening fast enough. And that disappointment matters. Markets do not merely respond to reality. They respond to the gap between expectation and reality. When people have already priced in comfort, even a smaller discomfort can hit like a punch. That is why so many investors misread danger. They think they are reacting to facts. Often they are reacting to violated hopes. Look carefully at what is happening underneath the headlines. Oil is not just a number on a screen. It is a transmission fluid for the whole economy. When oil rises, people notice the pump first because that is where pain feels personal. But the pump is the appetizer. The real bill arrives later. Ships burn fuel, trucks burn fuel, planes burn fuel, warehouses, fertilizers, plastics, transport networks, distribution schedules, all of it starts to feel strain. Costs move through the economy like water through cracked stone quietly at first, then everywhere. And when people tell themselves this is only a gas station story, I know they do not understand the auction room they are entering. Food is not separate from energy. Supply chains are not separate from inflation. Tariffs are not separate from margins. Fertilizer is not separate from groceries. If the cost of moving goods rises, if supplier networks are forced to reroute, if key agricultural inputs jump sharply, the final bill will not be paid by a press release. It will be paid by households, by margins, by confidence, by repricing. That is the hidden mechanism. Most people watch the first-order shock. Very few people track the second and third-order consequences. That is why they are always emotionally late. They say the war is over there. They say the tariff fight is political theater. They say supply chain restructuring is an industry problem. Then 6 months later, they are asking why everything feels more expensive, why businesses are guiding lower, why markets no longer trust the same growth story, why the central bank sounds cautious, and why their comfortable assumptions suddenly feel thin. This is exactly why I care less about whether you can predict every headline, and more about whether you understand the auction room. You do not need omniscience. You need structure. Most investors act as though markets reward intelligence in proportion to prediction. That is not how the game works for the majority of people. For most families, for most workers, for most retirement accounts, for most new investors, the large fortune is not made by brilliantly forecasting each twist of policy or each month of inflation. It is made by behaving correctly. When the auction room gets noisy, that is why behavior is not a side issue in investing. It is the main issue. Let me say it more brutally. When prices are rising and everybody is cheerful, you do not need much character to buy. You need pulse, convenience, and a brokerage app. Bull markets are crowded. Bull markets flatter weak habits. Bull markets let people confuse momentum with judgment. Bull markets make sloppy behavior look intelligent. That is why so many people feel smart near the top and terrified near the bargain rack. But money is not made in the feeling. It is made in the price you pay for ownership. The market spends more time in good moods than bad ones. That is true. But the windows that create outsized future returns are usually opened by fear. Not comfort. The auction room is not open all the time. That is what makes it valuable. Rare discounts do not arrive wrapped in pleasant emotions. They arrive wrapped in bad headlines, angry television, red screens, and social pressure to do nothing or do the wrong thing. If you do not train your mind before the room opens, you will behave like everybody else inside it. That is the psychological damage most people never diagnose in time. They think their enemy is volatility, their enemy is self-protection performed at exactly the wrong moment. They think selling after a drop is prudent because it reduces immediate pain. They think waiting for clarity is rational because it sounds adult and careful. But the market does not charge people for sounding careful. It charges them for giving away future compounding at markdown prices. The worst mistake in a bear market is not fear. It is fear dressed up as strategy. I saw this clearly after 2022. Plenty of people sold because they wanted to wait for the bottom. That sentence sounds intelligent. In practice, it usually means this: I want maximum future upside with minimum emotional discomfort and no chance of short-term embarrassment. That is not an investment strategy. That is a fantasy contract with reality. Reality never signs it. The bottom never rings a bell. Recovery always feels suspicious at first. The first move off the bottom always looks like a fake bounce to people who missed it. The second move looks dangerous because price is already higher. The third move feels unfair. Then eventually those same people call the whole thing obvious in retrospect. That is why the auction room punishes ego. Now let me bring this down from market philosophy to economic math, because if you do not understand the math, you will keep returning to the same emotional mistakes. Suppose you own broad productive assets through low-cost funds or strong businesses. If those assets fall 15%, 20%, or 25%, your future expected return has often improved. Not worsened, provided the productive engine under them still works. Price is what changed first. Value adjusts more slowly. If the economy survives, if earnings power survives, if the ownership claim survives, then lower prices are not merely scary. They are mathematically generous to the disciplined buyer. That is what most people cannot hold in their head at the moment they need it most. They think in pain units, not future return units. They think in headlines, not entry prices. They think in calendar weeks, not compounding decades. I have spent my life caring about one central idea: how much am I paying for a future stream of cash and productive power? That question does not become less important during a correction. It becomes more important. A falling market is an argument about near-term fear. Ownership is a claim on long-term productivity. When the argument gets emotional, the claim often gets cheaper. That is why I do not want you obsessing over whether a correction will become a crash or whether a crash will become a recession or whether the next central bank meeting will be gentle or severe. I want you to understand which game you are actually playing. If you are a trader, you are playing a reaction game. If you are an owner, you are playing an acquisition game. Most ordinary people claim to be owners while behaving like frightened traders. That mismatch destroys them. And it destroys them most brutally in two categories. The first category is the newer investor. The newer investor is especially vulnerable because they have not yet built a history inside their own nervous system. They have not lived through enough fear to recognize that red is not always danger. Sometimes red is the admission price to future green. The new investor sees a decline and assumes they made a mistake. They assume their first real downturn is proof that investing itself is broken. They assume time works against them because they have not yet seen time flip and begin working for them. That is why the early years matter so much, not because your account is largest then, it is usually smallest then. They matter because that is when you either build your auction room identity or destroy it. Either you become the person who buys productive assets more confidently when prices improve, or you become the person who needs reassurance at the exact moment reassurance is most expensive. The second category is the investor close to or in retirement. This person faces a different pain. The problem is not only fear, it is sequence risk. It is the terror of drawing from a falling portfolio. It is the sense that time is suddenly less forgiving, and that fear is not imaginary. It must be respected. But respected does not mean obeyed blindly, because investors near retirement often respond by becoming too simple in the wrong way. They seek safety in labels rather than in structure. They hide in low-yield cash while inflation quietly eats them. They confuse lack of movement with lack of risk. They turn away from ownership altogether because volatility feels offensive at the stage when stability feels most precious. That can be just as destructive, only slower. If you are near retirement, the answer is not panic. The answer is design. A real cash buffer, a real spending policy, a real asset mix built for withdrawals and endurance. A real understanding that the most dangerous thing is not a temporary price decline alone. It is being forced to sell good ownership at bad prices because you refuse to build a system before the auction room opened. This is where most people drift into the wrong conversation. They ask, what is the best ETF right now? That is not the first question. The first question is, what rules will keep me from sabotaging myself when the room gets loud? Without that answer, product selection is decoration. You do not need a portfolio before you have a policy. You do not need opinions before you have rules. You do not need more information before you have a framework. When I bought businesses, I was never looking for excitement. I was looking for understandable economics. Durable incentives, decent prices, and the temperament to sit still after I acted. Public markets are not different. Just because the screen flashes every second, the screen is not intelligence. It is noise delivery. If you want to win in the auction room, then build your rules before the next wave of fear hits you. Know what percentage of your income gets invested, no matter what. Know which broad funds or asset buckets are your core ownership. Know what your emergency cash is for and what it is not for. Know whether a correction means rebalancing, additional buying, or simply continuing your schedule. Know how much market decline you can tolerate without rewriting your philosophy every weekend. Know the difference between your liquidity needs and your ego needs. That is how disciplined people turn chaos into transfer. And here is the part that sounds less glamorous but matters more than all the pundit theater in the world. Automation is moral armor. Most people think automation is convenience. I think it is self-defense. If your investment behavior depends on waking up brave every time the world looks ugly, you have already lost. Courage is too expensive to source on demand. Systems are cheaper. Systems do not need confidence. Systems do not need a perfect mood. Systems do not need a clean headline. Systems keep walking when emotion wants to kneel. That is why I prefer a written policy to 1,000 market opinions. If you have already decided that a portion of every paycheck goes into broad ownership, then downturns become less like an existential crisis and more like an altered price environment. If you have already decided how you will rebalance, what cash reserve you hold, what risk level you can survive, and what counts as a change in value rather than a change in mood, then the auction room loses its power to hypnotize you. That is the system shift. You stop asking the market to tell you how to feel. You tell yourself what to do before the market tries to bully you. Now, let me make one thing painfully clear. I am not telling you that every decline is a gift in the same way, or that every asset deserves blind averaging, or that valuation does not matter, or that concentration risk disappears just because something is popular. Number of the auction room still requires judgment. A bad business at a lower price can still be a bad purchase. A fad with deteriorating economics can still be a trap. A sector loved by speculators can still deserve repricing. I am not arguing for stupidity with conviction. I am arguing for disciplined ownership over emotional reaction. If the economy is dealing with geopolitical conflict, oil pressure, tariff shocks, stubborn inflation risks, supply chain strain, and concentrated fear around major growth companies, then yes, volatility can continue, yes, headlines can worsen, yes, the room can get noisier before it gets calmer, but none of that changes the central question for a long-term investor. Are productive assets being offered at prices that improve your future odds? And do you have the structure to keep acting while others are retreating? That is the only question that matters inside the auction room. Everything else is theater, and theater is expensive. It tempts you to believe that urgency is intelligence. It tempts you to believe that a new headline deserves a new philosophy. It tempts you to believe that because the room feels dangerous, the price must be wrong rather than attractive. It tempts you to confuse public fear with private opportunity. I have made a lot of money by refusing the theater. I do not need the whole room to agree with me. I need a sensible asset, a sensible price, and the emotional ability to stay in my chair while everyone else runs laps. That is what I want for you, but I do not want it for you in a soft, decorative way. I want it for you because the cost of not building it is enormous. Every major decline will keep ambushing you until you build a behavior system stronger than your instincts. Every correction will keep feeling like a verdict on your intelligence. Every red year will tempt you into the same ritual: fear, hesitation, sale, regret, envy, re-entry. At higher prices, then another round of fear. That is not investing. That is volunteering to be harvested. And the market is very good at harvesting undisciplined people. So here is the escape path. First, stop calling yourself a long-term investor. If your behavior is controlled by short-term mood, either become an owner or admit you are still trading your feelings. Second, define your auction. Room plan before the next ugly week arrives. Decide what you buy, how often and what amount, and under what conditions you rebalance or add. Third, separate your emergency life money from your ownership money. The market is not the place to store next month, rent, or next quarter. Panic, liquidity buys dignity. Ownership buys freedom. Do not confuse the two. Fourth, use broad, low-cost structures for the core of your plan. If you do not have the time, edge, or temperament to value individual businesses with rigor, there is no shame in buying the productive engine of the economy efficiently. The shame is pretending sophistication while behaving irrationally. Fifth, understand that the rare bear market is not the period to abandon the field. It is the period to acquire your future at better prices, provided your financial life is built to survive the noise. 6. Train your mind to measure success by process during the decline and by compounding after the decline. During the storm, a good decision may still feel bad. Your nervous system is not the scoreboard. 7th. Stop worshiping clarity. By the time the room feels safe, the bargains are usually gone. You are not being paid for comfort. You are being paid for correct action in emotional weather that other people cannot tolerate. That last point is where ordinary people usually fail the test. They want a clean entrance. They want certainty. They want permission. They want someone on television to say the danger has officially ended. But the market does not reward permission seeking. It rewards prepared ownership. That is why I think periods like this matter so much. Not because they make for exciting news, not because they let commentators sound dramatic. They matter because they reveal who has a framework and who has a dependency. They reveal who built rules and who built excuses. They reveal who understands the auction room and who merely wanders through it looking for emotional shelter. This is not a game of having no fear. It is a game of having a system that does not bow to fear. If you are new, this may be one of the most important classrooms you will ever enter. If you are near retirement, this may be one of the most important design tests you will ever face. If you are in the middle building wealth year after year, this may be one of the rare windows where the future offers itself at a lower quoted price while the crowd tells you to wait. And that is where your life can split. One path is familiar. You keep consuming headlines, keep searching for the perfect bottom, keep reacting, keep holding too much cash for too long, keep buying confidence at high prices and selling discomfort at low prices, and years later you tell yourself that markets are unfair. The other path is colder and better. You write your rules, you automate your behavior, you build real liquidity. You own productive assets intelligently, you expect fear, you act anyway. You walk into the auction room knowing exactly why you are there. Most people will not do that. They will want comfort more than freedom. They will want certainty more than ownership. They will want applause more than results. You have to decide which kind of person you are before the room gets louder. Because when the next wave hits, you will not rise to your intentions. You will fall to your system. And if you still do not have one, then the auction room will do what it always does. It will take wealth from the emotional and hand it to the prepared. That door is open. Now the question is not whether the room is scary. The question is whether you came to watch or to buy.